So, good morning everybody and welcome to today's meeting of the Corporate Governance Committee, which is taking place at County Hall in Glenfield, though colleagues from Thornton will be joining remotely. I'd like to remind everyone present that this meeting will be broadcast live via the County Council website and will also be available for viewing after the meeting. Can everyone please switch their microphones on when speaking and then turn it off when you have finished. I've received apologies from Mr. Bolter and also from Mr. Richardson, with Mr. Parton acting as substitute. So item 1 on the agenda is question time. I've received no questions from members of the public. Item 2 is questions asked by members under Standing Order 7.3 and 7.5. I've received no questions. To advise any other items which the Chairman has decided to take as urgent elsewhere on the agenda, there are no urgent items. So the next item is item 4, declaration of interest in respect of items on the agenda. Do any members have any declarations of interest you wish to make? No. So that's nobody has any declarations. So this meeting has been arranged to consider the external audit of the 2020-21 Statement of Accounts, Annual Government Statement and Pension Fund accounts as set out on pages 3 to 80 of the agenda pack. Nick Walsh, Head of Finance, will introduce the item before handing over to Barry Morris, Audit Director from Thornton, who is attending the meeting remotely today. So, Nick, over to you, please.
Yeah, thank you very much, Chair, and morning, everybody. I won't say much in relation to the details of the report because, as you said, Chair, we've got Barry Morris and Andy Reid from our auditors, Thornton, joining us remotely, and they'll talk you through the detail of their report. So, and which obviously we're welcome to both of those two. Barry's the Audit Director and Andy is the Senior Audit Manager. In terms of the audit, there are still 1 or 2 loose ends to tidy up, but overall the big positive for me is that once again looks like we're going to be getting an unqualified opinion. At least that's what's anticipated as it stands at the moment. It's worth highlighting, I think, it's mentioned in paragraph 7 of the report, but there have been a number of factors that have made the audit much more challenging this time than usually would be the case. In particular, sort of the combination of the financial year being split over 2 financial systems, because obviously we went live with Oracle Fusion partway through the year. The significant additional volume of activity and changes to working practices due to COVID-19, and the sort of significantly higher level of audit testing that's been undertaken than in previous years. And also it's been Barry and Andy's first year with LCC, doing LCC accounts, and Barry in particular had to take over partway through the financial year. So all of those factors have kind of just sort of added into the mix, really. All of this has meant that it has been particularly important for LCC staff and Thornton staff to work closely together in delivering the audit. And I'd like to thank Barry and Andy and all their staff for ensuring that this has happened so effectively. But obviously also I would like to thank LCC finance staff for all the hard work they've put into this process too. There are 4 recommendations that I just want to briefly touch on. Obviously Barry and Andy will go into them in more detail, but so we're essentially on paragraphs 14 to 18 now. So firstly, there were a number of bank reconciliations not completed, and this was linked to some of the new process arising from the Oracle Fusion implementation. And on that, I'm pleased to report that the number of these has now been reduced, and we continue to work through those which remain. There was also a small difference in relation to the sales ledger at year end, again linked to reporting from the new financial system, specifically the aged debt report and timing of entries. Work is ongoing to ensure these differences are resolved. With respect to the pension fund, there were some additional disclosures required by SITFA for the annual report, but these weren't included, or some of them weren't included. These gaps were brought to the attention of the local pension committee on the 26th of November, and the missing disclosures will be included for the 21-22 pension fund annual report when that's produced. And then finally, as part of the external audit work, Thornton's specialist IT team carried out a specific audit of the IT in relation to the impact on the financial environment. And there was a recommendation arising from this work in relation to segregation of access within Oracle Fusion. There were some internal and implementation partner staff with access to both the development and production environments. And much of the issues there were linked to the fact that we've gone live with different aspects of the system at different times over the year, especially in relation to Nottingham City Council as well, also kind of coming on board slightly later. But as we move into post-go live changes, and they're all at that point, they will all be carried out by the systems implementation team. So obviously the implementation partner won't have access at that point. And that we'd be left with a small team who have access to both environments at that point. And there are procedures in place to manage these, including a monitoring log of changes that are made. But obviously we will continue to look to increase controls where feasible. You'll notice in paragraphs 19 and 20 that the separate work on the value for money audit is ongoing. This is expected to be completed by the end of January and will be reported onto this committee following that completion of the work. And then just finally, I do need to point out that since the version published as part of these papers, there is one minor change to Appendix B, the representation letter. There is an additional observation added in as point 14 or XIV in the Roman numeral notation used in the letter. This reads, the prior period adjustments disclosed in notes 20 to the financial statements are accurate and complete. There are no other prior period errors to bring to your attention. So thank you, Chair. Unless there are any specific questions for me, I think we can probably hand over to Barry and Andy.
Thank you. Has any members got any questions? I mean, I think that's a very good summary of where we are and the additional reporting requirements that sit for demand of us. But I would hand over to Barry Morris now. Andy Reid, I think.
Thank you. Thank you very much, Chair. So I'm Barry Morris from Grant Thornton, and as Nick said, I'm the Audit Director. So what I'll do is I'll give a high-level summary from our perspective and the audit perspective, if I may, and then I will hand over to Andy to take you through the detail and the sort of finalisation arrangements as we come towards the conclusion of the audit. I'd just like to echo really what Nick said. This has been a very challenging year for a number of reasons, not least the ongoing pandemic, which has meant that we've had to work and operate remotely, but also the implementation of your new financial ledger system partway through the year, which has meant that we've had to do testing across 2 different systems. I think the other important thing to bear in mind is that the increasing focus of our audit work on those areas where there's significant judgments and estimates, such as plant and property valuations and pension liabilities, ever increases the amount of work that we do. And we've also introduced a new audit approach to looking at journals at the council, again following on from feedback from the regulators. The other additional, as well as having a new engagement lead and a new manager to the audit, we thought we drove the whole thing at you, and we also undertook a hot review of your accounts as well. Now, this is where our technical team do a very detailed review against your accounts to make sure that they're fully compliant with the code. So that's something that your finance team have supported us with as well. So I think your finance team feel well and truly audited this year. And I would express my thanks that I think your finance team have cooperated exceptionally well with us. They've responded very promptly to the queries that we've come at them, even where there's been new areas that they may not have had queries on in the past. So again, from our perspective, I would commend the authorities' finance staff and would pass on our appreciation to them. It's a team you should be proud of. In terms of the work, as Nick said, the most important thing, it is going to be an unqualified audit opinion. There are still some bits of testing that we do need to conclude in the final review of the file, but we're liaising closely with your finance team on that, and we are not expecting there to be any further significant issues arising as a result of that work. As Nick said, the value for money work, the NAO has recognised the challenges of the pandemic and the delivery of the value for money work, coupled with the fact that it's a new value for money approach under the new National Audit Office Code this year. So that work has been delayed and will be completed after we've provided the opinion on the financial statements. As Nick said, our intention is to get that to you by the end of January.
Brilliant. Thanks a lot.
I will hand over to Andy in a moment to go through the detail of the report. I will just take you to page 12 of the report, which sets out our materiality levels. So you will note there that there has been a slight reduction in the materiality level for the county council. That just reflects the implementation of the new general ledger. So basically what we're saying is there's an enhanced risk as a result of that. From my perspective and my review of the work and the auditor's work, I think the council has actually handled that transition very well. And again, certainly some of the challenges or fears that we might have had in such a large scale transition have not arisen. Chair, if I may, I'll hand over to Andy to take you through the detail of the report, and then both Andy and I will be happy to take any questions on either the county councils or the pension fund statements. Andy, over to you.
Thank you, Barry. So Andy, over to you.
Thanks, Barry. Thanks, Chair, and morning, everyone. Yeah, as Barry says, I'm happy to go through the detail of the report. It is quite a detailed report. There's quite a lot in here, so I was proposing to go through it, not exactly page by page, but just to highlight some of the key pages for members and just summarise the findings. So if I can start with page 9, which has the headlines. As we say on there, at the time that this report was issued, which is a week or so ago now, there were a number of areas where we were completing audit work. We are still tidying up some of the work in those areas, and we expect that will be concluded next week. The other key point to flag on there is we report one adjustment which impacted on the comprehensive income and expenditure statement for the council, which was a £31.4 million adjustment. This arose because of a change to the investment valuations in the pension fund, so it actually impacts both the pension fund and the county council. The reason it arose is because updated information on some investment valuations became available after draft accounts had been prepared. So I don't think that adjustment reflects an error as such by the council in preparing draft accounts. It simply arose because more up-to-date information became available after the draft accounts had been prepared. That was the only adjustment that's been identified that actually impacted on the comprehensive income and expenditure statement. If I can move on to some of probably the significant risk areas, which we start on page 13 of your pack. So during the planning process, we identified a number of significant risk areas. In the final report here, we provide an update on these. There were no new additional risks that arose, so all of these risks were as reported in our plan. So just to run through these quickly, on management override of controls, we undertook journals testing. As Barry says, the approach we took for this was complicated this year by the fact that we had to cover 2 ledgers, but also we applied a new approach ourselves to journals testing. But we're happy to report that there's no issues that came out of that we need to flag for your attention. Over the page, on page 14, another significant risk area we identified was around revenue recognition, and in particular around accounting for and recognition of the significant levels of additional grant funding related to the COVID-19 pandemic. I think as a county council, you had something like 60 million of additional grant funding that arose because of COVID-19. So one of the significant risks we'd identified was the need to make sure that had all been accounted for correctly, and also that matching expenditure had been accounted for correctly. Again, we're happy to report that we identified no issues in this area. At the time that we issued this report, we'd said that work was ongoing, but that work now is effectively complete, and there's nothing to report on that area. Over the page, on page 15, valuation of land and buildings was again a significant risk, and clearly it's a very significant number in the county council's accounts. And this is one of the areas, as Barry says, where as auditors we're having to have an increased audit focus and carry out significant levels of work around the valuation process because it is a significant estimate. The valuation is based on numerous underlying assumptions. as a county council, you use both an internal and an external valuer to undertake the valuation process. So it's clearly a complex area. Again, at the time that we issued this, work was ongoing and still to be finalised. Again, work now is substantially complete and there's no issues that have arisen from that. One thing that probably is worth pointing out, in last year's accounts, you included a material uncertainty caveat around asset valuations because of valuation uncertainty due to the COVID-19 pandemic. And this was common in, I think, most councils' accounts because of valuation guidance that had been issued to the valuers. For 2021, that material uncertainty caveat is no longer included, so that's no longer required. So that is a change in the disclosures that have been made in your accounts for this year. Moving on to the pension fund liability, again, this was a significant risk area for us. And again, we're happy to report that the work is complete. The only issue that arose from this was related to the updated valuation of certain investments within the pension fund, which led to a 31.4 million impact on the county council and a slightly higher impact on the pension fund accounts. But there were no other issues that arose in terms of the valuation of the pension fund liability. And then just to finish off, I think the last two significant risk areas are on page 17. The implementation of the new general ledger. As we've said, this was a significant change that impacted on our audit for this year. The only issue that arose from this was the weakness flagged by our IT audit team, which was to do with the segregation of duties as a result of the go live process, which Nick referred to in his introduction. There were no other issues that came out of that. So again, we were happy that it was a well-controlled process and there was no adverse impact on the accounts. And then the last point on here as a significant risk is from the pension fund side, the valuation of the level 3 investments, where there was a change to those valuations because draft accounts had been prepared based on interim valuations. Once the final valuations became available, there was an increase in value of those investments by 35.5 million. Again, this was a fairly common position for many pension funds this year, and I think it arose because of the volatility in valuations, again, due to the COVID pandemic. And these were particularly hard to value investments, which had originally been valued in the draft accounts based on, I think, December figures. And then once March figures became available, there'd been quite a significant movement. So again, it's no reflection on the processes or the quality of the accounts that were put together. It was factors outside of the pension fund and the council's control. To run through significant risk areas, I think the next point, a couple of points I'd like to bring to your attention. On page 22, under key judgments and estimates, we refer to the minimum revenue provision. I think this is just worth drawing to your attention because the council did change its approach to the calculation of the minimum revenue provision for the 2021 financial year. This would have been approved by council back in February. I think it was actually February 20, we say 21 here, but it would have been approved by full council before the start of the financial year. The result was that the minimum revenue provision charge made did reduce, but we were happy that the basis on which this had been done was a reasonable one. It was in line with relevant statutory guidance, and so we're happy that the minimum revenue provision raised was appropriate. On page 23, we refer to other adjustments or other amendments made to the financial statements for both the county council and the pension fund. These weren't issues that impacted on the reported performance, but were more presentational disclosure adjustments. And there are two on here that we identify. The first one was to do with grossing up of income and expenditure in the expenditure and funding analysis. So it wasn't the primary statements for the council's accounts as such, but one of the supporting notes where we'd identified an error where income and expenditure had been incorrectly grossed up. So that has been adjusted in the accounts. And then for the pension fund, we identified a misclassification of the investment assets between level 1 and level 2, which is the valuation hierarchies that are disclosed in the accounts. So again, that's an adjustment. It's a classification change, which we agreed has been amended in the accounts. So just worth bringing those to your attention as well. On page 24, we refer to the the pension fund annual report, which again Nick referred to in the introduction, where there were a number of areas which, as per SIPFA guidance, hadn't been included. These are must-do requirements as per SIPFA guidance. So we've listed them out there on page 24, and includes some information on financial performance, administration, includes the inclusion of a statement on value for money, which is something that will be required going forward. So this has no impact on our opinion, because our opinion on the pension fund report is simply that it's consistent with the annual accounts. But we do need to draw these to the attention of the pension committee, which I think we've already been informed of this, and yourselves, just to recommend that these are actioned going forward. We refer to internal control issues in here, which again Nick has already run through, so I won't go over those again. The only other point that I wanted to draw out, which it actually isn't in this report, but since we issued the report a week or so ago, we've completed that technical hot review of the accounts, which Barry referred to, and there were two issues, a number of issues that came out of that, but the most significant ones, which have been amended in the final set of statements. But there was an adjustment to the presentation of the expenditure and funding analysis, which is note 2 to the accounts. And the change that's been made there is to actually introduce some additional information to make it clear how that reconciles back to the position as reported to Cabinet. So there's consistency between the figures that appear in that note and the outturned figures as reported to Cabinet. So that change has been made in the accounts. And the second change was to note 20, which is the financial instruments note of the accounts, where on the hot review it was identified that the presentation of that note was incorrect and actually had been in the previous year as well. So that note has been reworked, restated. It's been updated in the set of accounts, which will be going for approval by the council. Because of the need to amend the prior year figures as well, that is effectively a prior year adjustment, which is why we've asked for that additional representation in the letter of representation that again Nick referred to in his introduction. So that note 20 has been restated. Both the current and prior year figures have been restated. We're happy that the restated figures are now correct, but again that's quite a significant change that was made after our audit findings report was issued. And I think those are the key points I wanted to pull out. I appreciate, as I said, there's quite a lot that we've covered there in quite a lot of detail. So happy to take any questions that committee members may have.
Thank you very much, Andy. I think that was fairly clear, and the reports that have been presented certainly show that finance team will be feeling very audited. Quite reassuring to hear your comments, and we've got an unqualified audit coming forward, hopefully. So over to members. Have you got any questions that you would like to ask? Neil.
Thank you, Chairman. It's not really a question, it's just a commentary, if I may. And I certainly echo your sentiments, Chairman, in welcoming the anticipated unqualified opinion that hopefully will be given with regard to the accounts. And I'm grateful also for the explanation on those significant risks as highlighted. And I note the reassurances, as I take it, that have been afforded during the presentation this morning. Specifically with regard to paragraph of the introductory report and the reference that the financial statements also include the annual governance statement. I note that there have been the 3 issues that have arisen since the balance sheet date, and I just think it's important to note the ongoing pressures on the adult social care budget, which continues year on and year on. And I know the council is ever presently aware of those pressures, but it is something that we should always bear in mind. I want to thank the authors of the report and the presenters this morning, and I look forward to getting confirmation of that unqualified opinion. Thank you, Chairman.
Thank you. Thanks very much, Mr. Bannister. Have we got any other questions or queries? Declan, you can't query your own accounts. Carry on.
So I wasn't going to
query the accounts. I just thought make use of sort of Barry and Andy while they're on the line. Andy pulled out the MRP, which has been in the press a little bit recently about sort of, I suppose some councils have pushed it a little bit far. I just wondered what your thoughts on other areas that maybe the committee should be aware of, that you've seen other councils fall foul of, that the committee maybe should be aware of over the coming year.
Chair, are you okay if I respond to that one?
Yep, I appreciate that. Thank you, Barry.
So Declan, you'll be aware, hopefully, and if not, let me know, that the Department of Levelling Up has just issued a consultation in relation to the clarification of the calculation of the MRP. I think one of the, or a number of the key areas that's seeking to provide, I don't want to say updated guidance, because the department says the guidance hasn't changed and it's therefore a clarification on the interpretation of the guidance, is that where the council has used borrowing for future gains, be it through investment property purchases, or where it's made loans to third parties for investment assets, or assets, fixed assets as we would call them, then MRP is payable on those, even though that may be offset by future receipts, either capital receipts or repayment of the loans that have been made. The other common area that some authorities have done is where they've received capital receipts, they've applied those capital receipts directly to offset the minimum revenue provision that's been made. So, for example, if you had a minimum revenue provision of £10 million and you had capital receipts of £2 million, you would have they've charged that £2 million directly to the MRP, therefore meaning you've only charged £8 million. That's incorrect. What they should be doing is allocating that capital receipts to the capital financing requirement. So therefore, if you had 100 million of capital financing requirement, your capital financing requirement would come down by 2 million to 98. And that in itself would then reduce the minimum revenue provision, but by a much smaller amount. So these are the key areas where we're finding some challenges at other authorities, either where they're not applying MRP to those assets which they've bought for future gains, such as investment properties, or where they've given loans to third parties, be them either external to the organisation or as a subsidiary of the organisation, and they've not charged MRP on that because that loan is effectively being repaid, or they've inappropriately applied capital receipts to MRP. There's some other bits as well, Declan, that's covered in the consultation, but those are the three large areas, I think, unless there was anything else that you wanted to ask about.
No, thank you. It's just general awareness for the committee about this. Sometimes things that just look like a technical accounting tweak and kind of sort of chain of events. It's just whether there's the MRP, that's a useful sort of background, but it's just when there's any other areas you think committees should kind of keep their beady eye on, as it were.
Yeah, and it's a really good point, because often MRP is an area that actually the in-year charge is at or around materiality and therefore doesn't necessarily gain much audit focus. That's why we have highlighted it this year, because whilst an in-year charge may not be material, if you're undercharging for investment properties, for example, that very quickly does ramp up and it would become a material issue over a number of years, or over a relatively small number of years. But yes, we've looked this year. We've noted your change. We don't have any concerns. We would be bringing those to you if we did. But again, we will obviously be looking to see how you've responded and how the clarification that's been issued by the department comes out in the fullness of time. So it's an area that won't go away.
Is that sufficient? Just one question from me. You're talking about the minimum repayment provision. Is if a council has bought an asset for say 100 million one year, and then they get the valuation in at 80 million the next year, how is that provided for?
So there's two different elements of it, Chair. So if you've bought an asset for 100 million 1 year and it's then revalued to 80 million, that's a loss. So the impairment in the value of that asset will be reflected through the accounts, and so it will show as 80 million. The minimum revenue provision is then repaying the borrowing in respect of that asset. So to an extent that the valuation has decreased, that doesn't really affect the borrowing that you've made on it. So you're still going to make the borrowing payments on that. And that's what the MRP is seeking to cover. So if you've got a loan for that asset and the life of that asset, whatever the value is deemed to be 50 years, then you would be charging £2 million a year in that example.
Thanks very much. I understand that. That's fine. So have we got any other questions or queries on that? We don't appear to have. That's very clear, very succinct, and thank you for all your work and for all our officers' work. I think this year has been challenging, to say the least, in terms of the issues with the finance team had to deal with, and in the middle of the pandemic they decided to change the accounting system, which it's gone relatively smoothly, all things concerned. But thank you very much for your work and for your very clear presentation this morning, and much appreciated. So the committee is firstly asked to consider the issues raised in the auditor's report, which we have done. Can I take the report as being noted and that all the comments made will be captured in the minutes in the usual way? Is everybody happy with that? Yeah. The committee is also asked to approve the draft letters of representation as set out in Appendixes B and C to the report. I am happy to move this recommendation, subject to the inclusion of the additional disclosures to Appendix B as discussed, that the prior period adjustments disclosed in Note 20 to the financial statements are accurate and complete, and that there are no other prior period errors to bring to the Council's attention. Could I have a seconder for that? Thank you, Mr. Coxon. Can I take it? It's agreed. It's no dissent. No dissent. Agreed. Thank you. Right. So that brings the meeting to conclusion. Please note the next meeting is scheduled to take place on Friday, the 28th of January, at 10 o'clock. As there are no urgent items to disclose, so thank you all for attending today's meeting. I now declare the meeting closed. Thank you. Thank you, everybody.